Karan Taurani joining us for more on that. He's Senior VP, Elara Capital, and of course tracks this space closely. Karan, great to have you on the show. I mean, I think the excitement about Zomato may drown out in the larger sort of up move that we're going to see in the markets today. But having said that, put into perspective why this is a big deal. And after all of the positive news on Zomato, is it still a buy right now?
Hi, Tamanna. Good morning. So I think what Zomato gives the investors is, comfort for high growth, better growth versus the traditional companies. And even in terms of profitability, the quick commerce business is currently at break-even point. So there's potential for better earnings growth as well. Both these segments, the food and the quick commerce segment, will see very strong double-digit growth. Food will be close to 20% plus in terms of top line, and quick commerce growth rate of 60%, 70% could go on for about 3 to 4 years basis how the non-metro situation pans out. So clearly very exciting time for investors to play on these high growth companies. And definitely, given the kind of track record and execution we have seen for Zomato, I think we're still very upbeat about its prospects. And I think in terms of valuations, the stock did make its peak at about 290, 300 rupees. And I think currently it's trading at reasonably fair valuations. And with the kind of growth and comfort that we have always got with the management, kind of always surpassing, ahead of their guidance, performing better, becoming market leaders in both the segments, and showing very resilient signs of, achieving profitability, because one has to see that this is the only quick commerce player with such a large market share at market leadership and is at break-even point largely, despite the heavy expansion that they've been doing in the last 6 to 9 months in terms of doubling the store count. So clearly, I think we do like Zomato. I think our target price is 320 on the stock, and we believe that once you keep rolling over annualized basis, we should see a 35 to 40% compounding return on this company.
Hi, Karan, it's Amina. That aside, in terms of inclusion, one other factor worth noting is the 8,500 crore QIP that has been approved now. How will this bolster Zomato's balance sheet, and what areas of business are likely to benefit most from this fundraise? What I also want to understand from you is, with this fundraise, there's going to be equity dilution of shareholders. How will the markets or investors view this, Karan?
So I think in terms of fundraise, as we all know that, the plan is very clear. They do not wish to kind of increase discounting in the business. So firstly, I think the fundraise is largely happening due to investments in the quick commerce business. That's the first thing. Secondly, the plan is not to, kind of increase discounts substantially. That is not the broader agenda. The agenda is to, invest in stores, invest in the infrastructure, the supply, the technology, the inventory, because quick commerce, is just very small right now. I think in terms of market, quick commerce is only about 3.5% of the e-commerce market, and potentially it can move up to 25-30% of the market in the longer term. That's the potential that it has. So clearly, I think that is the first thing which is there. Investments are going to be heavy in terms of quick commerce. Second, I think the competitive intensity has really picked up in quick commerce in the last 6 months, right? And that's also kind of, surprised everyone. But I don't think there's anything big surprise about it, because clearly quick commerce has got a very big potential in terms of total addressable market, right? So e-commerce players are the ones who are feeling the pinch of quick commerce, which means that the quick commerce business does have visibility, for long-term growth and for long-term profitability. And that is why e-commerce players are coming into the same. So we've seen Amazon, Flipkart making inroads, and some other new players as well. So clearly, I think this is like a war chest which will be there to compete with peers. And I think, since they are market leaders, they should have a higher cash pile, versus competitors. So if you look at the competitors today in the quick commerce segment, Amazon, Flipkart, come with deep pockets. But if you look at the likes of Zepto and Instamart, which are the current existing players, I think they have a cash pile of close to $1 to $1.2 billion. And even Zomato has got a similar cash pile, after this Book My Show deal, which they've recently done. Sorry, the Paytm deal they've recently done. So I think very clear that, they want to have a higher cash pile, because the kind of scale and size they operate, if at all they have to compete hard, with the competitors on anything, whether be it discounts, whether be it, technology, whether be it in terms of experience or in terms of inventory assortment put together, they should be well prepared for the same. There should not be any market share dilution for them. So they'll make sure that their market shares are well protected despite this high competitive intensity, and that's the reason for raising this kind of capital.
100% rally this year on Zomato. Do you believe Zomato's valuations are justified, or is it pricing in too much optimism? I also ask you this in context of the fact that Swiggy is at a deep discount in the same business, and we both know this is a duopoly.
See, I think in terms of Swiggy, one has to really go with the fact that Swiggy will always remain to be at discount versus Zomato, and there are reasons underlying the same. The three big reasons that we believe is that one is, of course, the revenue scale potential, right? So in terms of revenue scale, if you see, Zomato, both on the food and the quick commerce side, is about on an average 35 to 40% higher in terms of revenue scale, with quick commerce scale being far higher. In terms of valuation discounts, also the discounts will be maintained on the valuation multiple front, because clearly the profitability metrics are very different if you look at both food and quick commerce for Zomato versus Swiggy. And third is the hyper pure business, which gets a reasonable premium valuation and is probably operates at a larger revenue scale as well. So I think putting these three things into perspective, I think 60% discount is quite unwarranted, for Swiggy, versus Zomato in terms of total overall valuation in terms of absolute terms. Now, this discount can only converge from here on basis Swiggy's performance, right? Whether it could be Swiggy doing growth rates on par with Zomato, Swiggy improving its profitability metrics, which in turn could have a positive impact in terms of valuation multiples, right? So we haven't seen anything of that sort so far. If you look at the Q1 FY25 performance as well, which Swiggy had released, the numbers seem to be largely on track in terms of what they've been doing in the past, except for some bit of improvement in terms of food turning profitability in terms of EBITDA as a percentage of GOV. Otherwise, the metrics in terms of growth, the quick commerce growth, the quick commerce losses, they largely seem to be online. So unless we don't see any signs of very strong execution, both on growth and profitability for Swiggy, we may not see this discount of 60% on absolute valuation terms, converging versus Zomato. That's the first thing. Secondly, Zomato, of course, the valuations are a premium, right? But one has to really see the management execution, the kind of track record they've been posting. I mean, they've entered this segment of quick commerce much later. They've entered even the food business later. But again, they've really tapped onto multiple levers as far as profitability is concerned. They've got better take rates on the quick commerce side, whether it is because of better ad revenue, better inventory assortment, better AOV. So I think the execution has been top notch. And I think valuations will always appear premium. But, as I said, every year when you keep on rolling over,
Right.
there is a very good visibility of 30% plus growth. And that's going to kind of keep the stock under check.
Thank you, Karan. Always great getting your perspective on Zomato. It's become such a household name in more than one ways.